Okay, let's unpack this. Welcome to Talk Tickers, the earnings call summarization deep dive you asked for. Today, we're digging into Ormat Technologies. They're a really critical player, right? Sitting at that intersection of stable geothermal power and, the high-growth energy storage market, we're looking at their Q2 2025 results.
Exactly. And our mission here is, to go beyond just the headline numbers. We synthesize the beat, clarify the strategic pivot that management seems to be executing under the surface, and also translate the impact of these new policy tailwinds. They seem to be really accelerating the core business, which is interesting.
Right. So let's jump straight into the financials that hit the wire. Overall, the market reaction seemed pretty constructive, positive even. What were the key numbers driving that?
Yeah, it was a clear beat, both top and bottom lines. Ormat reported adjusted diluted earnings per share of $0.48. That significantly surpassed estimates by about 17%. And revenue did too. Came in at $234 million. That's a robust 9.9% increase year over year. And it beat consensus by around 5.6%.
Okay, so definite top-line momentum. How did that translate down to profitability, especially, given the current cost environment for these kinds of infrastructure players?
Profitability held up well too. Net income saw a pretty healthy 26.1% increase year over year, landing at $28.2 million. And maybe the most watched metric, adjusted EBITDA, hitting $134.6 million. Management really stressed this point. It was a record Q2 for both revenue and adjusted EBITDA. That's a 6.7% year-over-year increase. And they also maintained the dividend, confirming the quarterly payout of $0.12 per share. Stability there.
Okay. Now, here's where I think the story gets a bit more complex. The headlines look great, sure. But digging into the segment results, it really shows this clear strategic shift happening. It feels like a story of the high-growth segments really compensating for the traditional core business, which maybe temporarily took a bit of a hit.
That's a good way to put it. That temporary drag is, it's squarely in their legacy electricity segment. Revenue there dipped slightly, to $159.9 million, down about 3.8% year over year. But the core issue wasn't really the price of power they were getting. It was margin compression. Gross margin, they dropped pretty sharply, down to 24.2% from 33.5% in the prior year.
Wow, that's a serious shift in margin, over 9 points. What were the specific operational things driving that compression?
Management pointed to two main issues. Together, they caused about a $13 million revenue reduction. First, ongoing maintenance work at their Puna power plant that's scheduled, kind of a fixed impact. Second, continued energy curtailment in the U.S. This is basically due to third-party transmission line work and other grid constraints, things outside their direct control. But the crucial thing here, the insight, is that management sounded pretty confident. They stated this U.S. curtailment issue is expected to significantly lessen in the second half of the year. That implies the margin hit isn't, structural. It's temporary.
Okay, that makes sense. So while the legacy business was maybe catching its breath a little, the other two segments were really firing on all cylinders, right? Let's look at the product segment first. This is where Ormat actually makes its geothermal and recovery products.
Yeah, the product segment had a fantastic quarter. Revenue just surged 57.6% year over year to $59.6 million. But the real story there might be the margin recovery. Gross margin improved very sharply to 27.7%. That's way up from a pretty meager 13.7% in Q2 of 2024.
A 14-point jump.
Yeah.
That's huge.
Right.
Historically, the product segment, it's faced these profitability swings, right? Depending on contract timing and things like that. What gives us confidence this margin surge isn't just a one-off good quarter?
Two main things, I think, efficiency and backlog.
Yeah.
They specifically cited improved profitability on contracts, which suggests, they're executing better. But more importantly, that product backlog looks really solid. It's now at a robust $263 million.
Wow.
That's a 59% increase compared to Q2 2024. That gives them real visibility going forward. So management now projects the full year gross margin for products will probably stabilize in a higher range, maybe 21% to 23%.
Right. And then there's the segment that really seems to epitomize the future strategy. Energy storage. This segment posted, massive growth. Revenue up 62.7% year over year to $14.5 million.
Yeah, this segment really benefited from a few things coming together. New facilities reaching commercial operation in 2024, definitely. But also, critically, strong merchant prices in the PJM market.
Okay, just to ground that for listeners, merchant prices mean they were selling power directly onto the spot market?
Right.
Not under a fixed contract, a PPA. And PJM is the big grid operator in the U.S. Mid-Atlantic East Coast region. So high spot prices there translate directly to more cash pretty immediately.
Precisely. Management specifically called out the hot weather along the East Coast driving those higher merchant prices. That windfall basically helped push the segment's gross margin up to 11.9%, which is a big step up from just 5.7% last year. And given this momentum, they now think the full-year gross profit for storage should reach up to 20%. Pretty significant potential there.
Okay, let's shift gears a bit from the quarterly numbers to the strategic build-out and how they're paying for it. This growth trajectory management's outlining. It needs serious capital. So how are they de-risking that future build-out? Using smart M&A financial structuring.
Yeah, the strategy seems focused on leveraging existing assets, maybe undervalued ones, and also ensuring they have a robust financial cushion. On the M&A side, they closed the acquisition of that 20-megawatt Blue Mountain geothermal plant. What makes this plant interesting, strategically valuable, is the embedded upside potential.
And that upside ties directly to its power purchase agreement, its PPA, right?
Absolutely. The facility apparently is running under capacity right now, but its existing PPA expires in late 2029. And that PPA is currently priced somewhere in the low $70 per megawatt hour, which, is well below current market rates for geothermal power. So fast forward 5 years or so, that asset could potentially double its revenue per megawatt almost overnight, which is based on market repricing. That's significant hidden value baked into that deal.
And they're not just relying on buying assets either. We saw some major organic build-out announcements too. 25 megawatts of geothermal and 22 megawatts of solar PV capacity greenlit for construction at the Heber complex in California, plus another 3.5 megawatts at Blue Mountain in Nevada.
Exactly. And they're also, interestingly, structuring the leadership team to match this ambition.
Yeah.
We saw them add new executive talent, specifically focused on operational optimization and also that push into enhanced geothermal systems, or EGS. Yeah, they're bringing in specialized leadership, seems like, to handle the complexity of these next-gen technologies.
And to fund all this activity, they secured some serious liquidity. What was it, $300 million in new funding in Q2 and early Q3? A lot of that through these new tax equity deals, it seems.
Yeah, the specifics of the financing really tell a story of execution efficiency. They got $77 million from the Heber tax partnership, plus another $25.6 million coming over 8 years, really utilizing those new tax credit transfer mechanisms effectively. And they also locked in a $62 million hybrid tax equity deal with Morgan Stanley. That covers their Lower Rio and Arrowleaf storage and solar projects. So bottom line, total available liquidity is now a pretty healthy $551 million.
Okay. But we should address the capital strategy directly. With all this investment, net debt to adjusted EBITDA is sitting at 4.4 times. Now, that's maybe somewhat common in this capital-intensive infrastructure space, but isn't that ratio getting a little stretched, especially as they head into major construction phases?
It is slightly elevated for the sector, yeah. It signals that management is comfortable using debt leverage to sort of front-load this growth, especially, it seems, when they have high certainty around tax credits and future PPAs.
Right.
They're essentially betting that the future EBITDA growth from all these new assets acquired and built will swiftly bring that ratio back down. It's aggressive leverage, maybe, but it highlights their confidence, particularly in the regulatory environment they're seeing.
Speaking of regulation, what does all this mean for the longer-term picture? The policy environment really seems to be providing some serious tailwinds now.
Oh, the policy support is immense. Management actually enthusiastically called the legislation the Beautiful Bill.
Yeah, okay.
It essentially extends the runway for the production tax credit, PTC, and the investment tax credit, ITC, for both geothermal and energy storage projects that start construction all the way through 2033. That 9-year visibility, it's transformative for long-term planning in this sector.
And the regulatory red tape? Often the killer for greenfield development. That seems to be lessening too. They highlighted federal permitting reforms speeding things up.
Yeah, they gave a really striking example of the impact. Environmental permits in Nevada, which previously could take up to a year, are now in some cases taking as little as 2 months.
Wow. 2 months.
Yeah. Think about what that certainty means. It dramatically shortens the development cycle, lowers the risk of project delays, and it lets them hit those ambitious long-term capacity targets much, much faster.
Okay, now let's pivot to the storage elephant in the room, the foreign entity of concern risk, the FEOC rules. These govern battery sourcing and, crucially, tax credit eligibility. How are they handling that?
Right. Management confirmed minimal impact on the geothermal side. That makes sense. But storage is different. Like basically the entire industry, their storage segment is heavily reliant on Chinese source batteries. And the clock is ticking towards 2026. That's when the full FUMC restrictions kick in, potentially making those Chinese batteries ineligible for the critical ITCs.
So to counter this, they're doing this safe harboring thing. They're actively safe harboring capacity. What was it, another 1.6 gigawatt hours in 2025? Why is that 2026 deadline so critical, and how much of a competitive edge does doing this early safe harbor actually give them?
You know, the 2026 deadline is absolutely critical because that's when the rules about using component source from FEOCs fully take effect for the tax credits. By safe harboring, which basically means putting a minimal investment down now, like pouring a concrete pad or buying certain non-battery components, they lock in ITC eligibility for the entire project, even if the actual batteries are delivered later.
Ah, okay.
So they're securing ITC eligibility for their entire storage portfolio through 2028, maybe even beyond. That gives them years of operational flexibility, sourcing flexibility that many of their peers, who might be dragging their feet a bit, may not have. It's potentially a massive competitive shield for them.
Right. Switching gears slightly again to innovation, this push into enhanced geothermal systems, EGS technology, it's starting to materialize. You mentioned the new hires. Now, EGS is still, high risk. It's not proven at scale yet. But how significant would a breakthrough be for Ormat?
Well, success in EGS would fundamentally rewrite their growth story, no question. It would significantly expand the potential for both their project development and their product segments, because it would allow access to deeper, hotter geothermal resources that were previously just unreachable. Their strategy, though, seems pretty smart. They're initially focusing these EGS efforts on their existing facilities, which should lower the initial development risk compared to starting totally from scratch on a greenfield EGS site.
And all this innovation, all this capacity expansion, it's happening against a backdrop of, extremely high secular demand, right?
Yeah, absolutely. Management specifically cited growing demand for baseload renewable power, particularly they mentioned, to support AI data centers and just broader electrification trends.
Yeah, huge power consumers.
Exactly. And they're not just waiting for these opportunities to land on their lap. They said they are actively negotiating 250 megawatts of PPAs right now, specifically related to data center offtake. And that's using their existing proven geothermal technology.
So what's fascinating here is, despite that segment volatility we talked about, despite the slightly high debt, management confidence seems absolute. They reiterated the full-year guidance.
Yeah, showed no hesitation at all. They reiterated full-year 2025 revenue guidance, $935 million to $975 million, and adjusted EBITDA between $563 million and $593 million. And importantly, they also reiterated that long-term goal, reaching 2.6 to 2.8 gigawatts of portfolio capacity by the end of 2028. That long-term target now seems much more underpinned by that faster permitting process and the confirmed PPA demand they're seeing.
Okay, so we can probably anticipate several near-term catalysts then, second half of 2025 into 2026.
Definitely things to watch. We'll be looking for the commercial operation dates, the CODs for the Lower Rio storage project and the Airlie storage and solar project. Also, keep an eye out for incremental upgrades at that Blue Mountain facility they acquired. And maybe most importantly, the anticipated finalization of those 250 megawatts of data center PPAs should happen in the coming months, according to management.
Okay, let's move from the data to a bit of speculation. Time for our high-risk, maybe high-reward trade idea segment. Remember, everyone, this is analysis, definitely not investment advice.
All right, so the core thesis for this potential trade really exploits the urgency we just talked about around storage and FEOC.
Yep.
You've got a company sitting on a slightly elevated 4.4 times net debt to EBITDA ratio. But they've successfully locked in, arguably, superior growth drivers. Those extended tax credits, strong merchant prices right now, and that ticking clock of the 2026 EBITDA deadline for batteries.
Okay, so here's the outrageous but maybe plausible trade idea. What about a high-yield convertible debt offering, specifically designed to finance the immediate procurement of the entire remaining 1.6 gigawatt hours of batteries they plan to safe harbor in 2025? Buy them all now.
Right. The rationale is pure urgency. You aggressively front-load that capital expense for storage now, before the full FEOC rules potentially complicate things in 2026. This would instantly crystallize the tax benefits, those valuable ITCs, for the entire 1.6 GWh capacity. It would dramatically accelerate their storage growth pipeline. And it would allow them to fully exploit the current high merchant prices, like those PJM hot weather tailwinds we saw boosting Q2 results.
Yeah.
Capture that upside now.
So essentially, you're arguing they should basically double down on the leverage to aggressively capitalize on this policy window right now. You're betting that the certainty of those long-dated tax credits, combined with the superior merchant margins they could lock in with this early procurement, that would decisively outweigh the temporary spike in the debt load, locking in profitable growth through, say, 2029.
It's basically a move that says, look, we know how to navigate this policy maze better than our competitors, and we are going to press that advantage with maximum speed and, yes, with strategic leverage.
Okay, so the story of this quarter seems pretty clear then. A strong beat, definitely driven by those high-growth storage and product segments, secured by some excellent financing execution, getting those tax equity deals done, and really propelled forward by that significant policy tailwind, the beautiful bill. The energy transition, it clearly requires both that baseload stability, which geothermal provides, and flexible assets, which is storage. Ormat does both.
Exactly. And given those confirmed long-term targets and the fact they're actively negotiating 250 megawatts of data center PPAs right now, powering, one of the fastest growing demand sectors in the entire economy, the important question, I think, for you, the listener, to consider is this: how much of a premium should be placed on a company that provides critical, reliable baseload power and also manages to successfully navigate its battery supply chain and secure those tax benefits potentially better than its peers?
Interesting question. Food for thought indeed. And remember, this analysis is based solely on the earnings call and the related materials we reviewed. This is not investment advice.